Today we'll discuss a very interesting topic, that is financial markets and products. Those people who are related to treasury, corporate, retail and other kind of financial and banking services, it will be quite exciting for them. It will give an opportunity to understand the mechanism behind the products and the variety of products that we have available. Suppose you work in a bank, they have no treasury services, or maybe they are not into derivatives, so it will be a quite value addition for you. I will start what is the concept of options, futures and derivatives. We'll discuss that what is a call option, what is a put option, when we give this call option, when we give this put option, and when we equate as a put and call parity theorem. Of course, we have two words, one is forward and one is future. Generally, when we do a trade goes in this way, that there is a buyer and there is a seller and there is a product available, so we exchange goods and services against an agreed price. This called as a normal trade. Every day we do the same. But what if we have an exchange of buying, we have an agreement, goods and services will be exchanged in the future. There is a buyer, there is a seller, there is an agreed price. So because product is not exchanged today, it will be exchanged in future. So we cannot call it as trade. So this create a concept of future and forward. The difference between them is the counterparty will not be known at the time, and in one contract counterparty will be known because buyer and sellers knows each other. So what are these things and technical stuff we will discuss today. We'll discuss derivative. Derivative is a word derived from an economic activity which has a specific definition. I will explain when appropriate time will come. We'll see how the future markets works, how I can buy today a rate of dollar for next 4 months, pound, euros, and interest rate, currency market, commodity markets, how they work actually. This is a very interesting discussion. Hedging strategies using futures. Hedging is a very interesting term, and in banking and financial sector, this is an everyday job. What is hedging? Hedging is offsetting your risk against adverse price changes. So if I am feeling that Britain is going to choose to exit from EU, and I'm anticipating that with this effect they will face a sudden decrease in the currency, and decrease in currency of course will be very favorable for me if I am into conversion, because I have to pay less to get the more pounds, for example. And it can be opposite. We can see that any step of any country will create their currency higher, so we have to pay it more to get it. So in order to decrease the effect of increase and decrease, we use hedging. Banks gives a lot of products that you can secure yourself by buying a forward rate 15 days, 30 days, 60 days. So any change comes will not affect the ultimate user. So how it works as a hedging strategy. This is a very interesting topic, and we will discuss what are the long-term, short-term, medium-term strategies we have in terms of hedging. Interest rates are very key as a monetary policy, the policy made by the central bank. The interest rate can be is a very effective tool in order to bring economic boom or recession in a particular area. So when interest rate goes higher, how it affects the other financial products. When it goes lower, how it boosts up. This is all we will discuss in interest rates. Determination of forward and future prices, how we determine the prices by demand and supply or other forces. This is we will discuss in detail. How interest rates is determined in future, how we can do swaps. Swap is another financial term. For example, you have an existing stream of cash flow and you are unable to pay that specific as your liability. So you are finding an alternative series where you can pay a lesser amount today and maybe later a higher amount because your cash flow is not good. So we try to swap the existing cash flow stream with the new one. So swapping is something very common, and there is always an intra-war between different providers that if I am taking 6%, so someone new who has money, they can try to attract the client by giving them a lower rate, so they can swap their existing liability to the new lenders. So swapping can be for interest rate, it can be a default swap, it can be for interest rate, it can be for currency. So a lot of type of swaps are available. Mechanism of option markets, how they work as an option, how we give call, put, what are the needs, what is American option, what is European option, which option we can exercise before the maturity. This is all we will discuss. Of course, what is the property of stock option? So when we issue stock, equity in terms of preference and common, how it works. Trading strategy involving options. So how a portfolio can be built up, what would be the trading, like buying and selling strategies in terms of stocks by keeping call and put options. Exotic options are interesting. These are the options which are differently settled in American option and European option, which are two commonly read options, and the difference between these options is in terms of their payoff. So I will discuss in detail that what is an exotic option and how it works. Commodity, forward and futures. This is, I already discussed a little bit about forward and future, that there is a buyer, there is a seller, and there is an agreed amount, and the exchange of good will be after a certain time. It can be good for agriculture products, where both parties, like McDonald's and the farmer, they sit together, they have an agreement, and after 4 months when the crop will come, they will settle their trade. And so before that it will be a forward contract. Future contract, I can buy a dollar rate maybe after 6 months, and I don't know who is going to buy that time. So only difference is that I don't know the counterparty who is the buyer. So more discussion will be done soon. Foreign exchange risk, as previously I explained, banks has interborrowing rates, then we are into too much investment of derivatives, future, forward. So everyday currency is going to up and down. So how it affects, how it create a risk, an obstacle, and which can keep us away from our objectives. How to handle, how to manage, this is we will discuss. Then we will discuss over the counter markets, derivative markets, and the concept of SPV, that is special purpose vehicle. Then we will discuss about central clearing, how it works, what are the advantages and disadvantages, what are the benefits to use this, what risk it creates, and how we will handle, mitigate, or reduce, or share. This is all we will discuss. In terms of corporate bonds, bond is an interesting topic in terms of your fixed income, where you are going to spend some money and you will get some return. Bond has a lot of types. You can classify in terms of securitization, unsecured. You can see it with the payment of cash flow, like a regular, perpetual, annuity, and we can see it backed by a commodity or not backed by a commodity. It can be a debenture. So bond is an interesting topic, how to value bond. This all will be discussed in terms of corporate bond. MBS is very famous, mortgage-backed securities. When we go for lending, of course, we have to make ourselves secure. So a lot of time we have to mortgage our capital assets. How we do, what is the advantage, disadvantage, how industry works. This is a very interesting discussion. In the last, we'll see what are the rating agencies who give ratings to the companies, the bond stocks. So we have Moody, Fitcher, Standard and Poor's, and all time we have a rating. So how this rating is calculated, what is the concept of capitalization, and how these ratings will be factored in the what key factors you have to keep in consideration. This is all we will discuss in this chapter. Now we'll start our first discussion, that is a derivative markets and how it works. This is I am going to explain.